Today we're covering the Federal Reserve and its monetary policy tools, a key topic under the Economic Factors and Business Information section of the Series 65 exam. The exam will test your understanding of how the Fed tries to influence the economy by controlling the money supply. The Federal Reserve System is composed of the Board of Governors and 12 regional reserve banks. For the exam, the most important group to know is the Federal Open Market Committee, or FOMC, which is responsible for conducting open market operations. Open market operations are the Fed's primary tool for implementing monetary policy, and you will absolutely see questions on this. It involves the buying and selling of government securities, like Treasury bonds, in the open market. When the Fed wants to stimulate a sluggish economy, it will buy government securities from banks. This action injects money into the banking system, increasing bank reserves. With more money to lend, interest rates tend to fall, which encourages borrowing and spending. This is known as an expansionary or loosening monetary policy. Conversely, to combat high inflation, the Fed will sell government securities to banks. This pulls money out of the banking system, reducing their ability to lend. With less money available, interest rates rise, which discourages borrowing and helps to slow the economy down. This is a contractionary or tightening policy. A common exam trap is to confuse the effect of buying versus selling. Remember this simple phrase: Fed buys, money supply gets bigger. Fed sells, money supply gets smaller. Another tool is the discount rate. This is the interest rate the Fed charges member banks for short-term loans. A lower discount rate makes it cheaper for banks to borrow, encouraging lending and expanding the money supply. A higher discount rate makes borrowing more expensive, restricting lending and tightening the money supply. Do not confuse the discount rate with the federal funds rate. The federal funds rate is the rate banks charge each other for overnight loans, and while the Fed sets a target for it, it is determined by the marketplace. The exam will test this distinction. The Fed is the lender of last resort, so the discount rate is typically higher than the federal funds rate to encourage banks to borrow from each other first. The final tool is the reserve requirement, which is the percentage of deposits that banks must hold in reserve and cannot lend out. If the Fed lowers the reserve requirement, banks have more excess reserves to lend, increasing the money supply. If they raise the requirement, banks have less to lend, decreasing the money supply. Of the three tools, open market operations are the most frequently used and most important for the exam. The exam will present scenario questions, asking you to identify the appropriate Fed action. For example, if the economy is in a recession, the Fed would likely buy securities, lower the discount rate, or lower the reserve requirement. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.